Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Good morning.
We've got a really interesting set of stories breaking down today, and our mission, as always, is to dig beneath those headlines from sources like Bloomberg, MarketWatch, and the Wall Street Journal.
Yeah, absolutely. We want to give you the crucial insights, figure out what it all really means for you.
It feels like we're at a bit of an inflection point across several markets, doesn't it?
It really does. Lots cross currents impacting everything from precious metals, big tech, even the future of travel.
Okay, let's unpack this. Let's start with the wild ride we're seeing in gold and silver.
Yes.
MarketWatch had a piece, Gold Prices Plunge and Biggest One-Day Drop in Years. Is the record rally over?
And the Wall Street Journal had an interesting counterpoint. Miss the gold rally, go for silver. Plus, Bloomberg touched on it, too.
So gold took quite a tumble.
It certainly did. MarketWatch said gold futures saw their biggest one-day drop in, well, years. A hefty 3.7% on Wednesday.
Ouch. What did that put the price at?
It closed at $3,294.10 for the June contract. Yeah. And this was after it had been flirting with levels over $3,500 an ounce.
So what happened? What triggered such a, sharp reversal?
Well, MarketWatch pointed to a couple of key things. First, maybe some easing anxieties about President Trump's tariffs policies potentially escalating.
Okay.
And second, perhaps a slightly less aggressive stance or perceived stance towards Fed Chair Powell.
So kind of like the things that were pushing it up lost a bit of steam.
That's a good way to put it.
Yeah.
And the analyst takes are, well, they're all over the place, really.
Naturally.
Michael Armbruster from AltaVest thinks this is probably just a normal correction in a bigger bull market.
Yeah.
He doesn't necessarily see $3,500 as the top.
Okay, so just a pullback.
But then you have Jonathan Krinsky of BDI. He pointed out that gold had gotten really stretched, like way above its 200-day moving average.
How far above?
27% above. At the time, the average was around $2,729.81.
Right, and the 200-day is that key long-term trend line people watch. Getting that far above can sometimes signal things are overheated.
Exactly. Krinsky suggested this rapid move might have been a blow-off phase. And historically, when you see that kind of separation, the price tends to revisit, or at least test, that 200-day average within, say, 3 to 6 months.
Interesting, like gravity pulling it back down.
Sort of, yeah.
Yeah.
Market finding its equilibrium. Jim Wyckoff at Kitco.com sort of echoed that, suggesting the market might be nearing a climax, time-wise, even if prices could still pop short-term.
Did he give a key level to watch?
He did. He said watch $3,200. A drop below that would be, in his view, a negative signal.
Okay. What about the trade angle?
Stephen Innes from SPI Asset Management talked about that. He reckons the trade war pillar supporting gold is weakening a bit.
Because the White House might cut some China tariffs.
That's the thinking. Plus, he mentioned the U.S. dollar stabilizing, which reduces the need for gold as, like, a panic hedge. So, several things coming together.
But not everyone thinks the party's over for gold, right?
Definitely not. Brian London from Gold Newsletter, Edmund Moy from U.S. Money Reserve, they both argued this correction doesn't end the bull run.
Moy made a good point about context, didn't he?
He did. He said, look, even with this drop, it's a small percentage compared to the huge rally gold's had since 2022, which was fueled by, geopolitics and inflation fears.
Right. And Trevor Yates at Global X ETFs?
He saw it more as positioning and flows. Basically, investors locking in profits after a big run, not a fundamental shift.
So the long-term bullish view might still be intact for some.
He thinks so. Yates pointed to strong buying from central banks and those ongoing stagflation worries as support. He even suggested this dip could be an interesting entry point for long-term believers.
Okay, so gold got ahead of itself, corrected, but the long-term story might not be broken. Interesting. Now that Wall Street Journal piece, missed the gold rally, go for silver. What's the argument there?
Well, silver is interesting because it has this split personality. The journal highlighted this.
How so?
It's a precious metal, so it has that safe haven appeal like gold. But it's also a major industrial metal used in electronics, solar panels, all sorts of things.
Ah, so its price is tied more to the economy than gold's.
Generally, yes. That industrial demand makes it more sensitive. Historically, when recession fears spike, gold tends to do better because investors just want the purest haven.
And the article mentioned the gold to silver ratio.
Right. It had hit about 98, though it's down from over 100. Still way higher than the 30-year average of around 68.
And a high ratio means?
It means it takes a lot more silver to buy 1 ounce of gold. Historically, when that ratio gets stretched like this, It can suggest silver is relatively cheap compared to gold.
And has that led to silver outperforming before?
The journal pointed out examples, yeah.
Mm.
After the initial COVID panic during the financial crisis, high ratios often preceded strong silver runs, like a rubber band snapping back.
But there's a catch, isn't there? Because of the industrial use.
Exactly. The article cautioned that if we hit a really severe global trade downturn, silver could suffer because that industrial demand would dry up.
So different risks than gold needs the economy to hold up or improve even.
Precisely. It really shows why you need to understand what drives each metal. Gold for geopolitical risk and inflation, silver adds that economic growth factor.
Okay, let's shift gears to the stock market. Feels like whiplash lately. The Wall Street Journal called it, "Huge stock swings are the new normal for frazzled investors." Bloomberg's updates echo that. April has been wild.
It really has. The market seems incredibly jumpy, reacting instantly to any news, especially anything about Trump, the Fed, or China trade.
Big daily swings, up and down, lots of uncertainty.
Yeah, and comments like Treasury Secretary Scott Bessent casting doubt on a quick U.S.-China trade fix don't exactly help calm nerves. China still wants those tariffs revoked, too.
So trade tensions are still simmering, and that seems to be hitting forecasts.
Big time. Look at Deutsche Bank. Bloomberg reported on this. One of Wall Street's biggest bulls slashes view as tariffs a bite.
They were pretty bullish before, weren't they?
They were. Now,
Yeah.
they've cut their year-end S&P 500 target by 12%, down to 6,150. That's a huge revision.
Wow. And what about earnings?
This is key. They now think S&P 500 earnings will decline 5% this year. The consensus was still expecting, like 8% growth.
Why such a big change?
Tariffs. They see the announced tariffs having a really large, disproportionate hit on U.S. companies. They even cut their 2025 earnings estimate way down, from $282 to $240 per share.
So they think tariffs are basically a massive tax hike on imports.
That's the estimate, yeah. A substantial increase in the effective import rate. But interestingly...
There's always a but.
Right. MarketWatch picked up on a different perspective from within Deutsche Bank research. Henry Allen.
What's his take?
He noted that while markets reacted to tariffs initially, they aren't currently pricing in an inevitable recession. The market moves aren't as severe as what we've seen before past recessions.
So a bit of a split view, even within the same bank. Tariffs are a risk, but maybe not an immediate recession trigger according to market pricing.
That seems to be the nuance. Allen does warn, though, that this leaves markets vulnerable if a recession does actually hit.
Okay, so the markets may be a bit complacent about recession risk, even with the tariff clouds.
Could be. It just highlights how tough it is to read the signals right now. The tariff impact is a real concern, as the DB strategists point out.
Amidst all the selling and volatility, who's actually doing the selling? MarketWatch had a piece based on JP Morgan analysis.
Yeah, it's hedge funds, not foreign investors, that have been dumping stocks. That was the headline.
So what did JPM find?
Their analysis suggests the recent sell-off was mainly driven by hedge funds cutting their equity exposure. We're talking like $750 billion year to date.
That's a lot of selling.
It is, including momentum funds unwinding long positions. But interestingly, they didn't see big net selling of U.S. stocks or bonds by foreign investors.
Huh. And what about retail investors?
Opposite story, according to JPM. Retail investors apparently kept buying domestic stock ETFs through this period.
So hedge funds de-risking, retail buying the dip. A classic divergence.
Seems like it. Maybe hedge funds getting cautious, taking profits, while retail sees longer-term opportunities.
Now, for those watching the charts, Bloomberg had an article on key S&P 500 levels traders are eyeing.
Right. Technical levels can give some clues, or at least psychological points. Daniel Kershaw at Jefferies mentioned 5,500.
What's special about 5,500?
Reaching it would erase half the drop from the February high. Kershaw thinks getting there could signal a shift, maybe from selling rallies to buying dips. If it clears that, maybe a rebound toward 5,800 or 6,000 is possible.
And on the downside?
John Kolovos at Macro Risk Advisors sees 4,800 as a potential floor, though he doesn't rule out lower, like 4,700 or even 4,480 or 4,300.
So quite a range of possibilities.
Absolutely. Jason Hunter at JP Morgan thinks the market is vulnerable to a sell-off, maybe down to 4,500, which he feels could actually establish a more durable bottom.
And they're also watching market breadth, right? How many stocks are participating?
In the percentage of S&P stocks above their 200-day average, it's around 31% now. Many think you need that closer to 50% for a really healthy, sustainable rally. Broader participation.
Okay, good technical context, but as you said, fundamentals like trade and the economy are key.
Always. Technicals are just part of the picture.
Let's move to some big company news. Alphabet earnings are coming up after the bell today. Bloomberg says they'll set tone for megacap earnings as headwinds swirl.
Yeah, Google's report is always a big one for tech sentiment, and Bloomberg points out some serious headwinds.
Like the antitrust stuff.
Exactly. That recent ruling finding them guilty of illegal monopolization, the ongoing fight about potentially breaking up the company, that's a huge cloud.
And competition in AI.
Intense competition.
Yeah.
Plus, the massive investments they have to keep making in AI, it's an arms race.
But there's still optimism, isn't there? People talk about the valuation.
There is. Some see a potentially cheap multiple, they don't have huge direct tariff exposure, and revenue growth is still expected to be strong, almost 12% this quarter, 12% for the year.
And earnings growth, too.
Expected, yes. 6.2% this quarter, nearly 10% for the year, accelerating after that. But
Another but.
consensus estimates for 2025 earnings and revenue have actually been nudged down a bit recently. So there's this tension.
Greg Halter at Carnegie Investment Counsel still sees the valuation as attractive, though.
He does. But Eric Clark at AccuVest Global Advisors asks a great question. Is it real value or a value trap?
Because of the AI spending and regulatory risks?
Precisely. Clark highlighted that massive $75 billion reaffirmed spending plan for AI CapEx in 2025.
That's huge, especially when Microsoft and Amazon seem to be pausing some data center builds.
Right. It raises questions about near-term profits and the return on that massive investment. Plus, more AI competition in search. It makes Alphabet's story less clear, Clark argues.
So a big bet on AI facing competition and regulators. Lots riding on these earnings.
It's definitely a high-stakes situation for them.
Okay, let's switch to crypto. Bitcoin. MarketWatch had a piece. Has Bitcoin halving lost its mojo? The crypto sees its worst ever post-halving performance.
Yeah, the halving happened back on April 19th. That's when the reward for mining Bitcoin gets cut in half. Historically, it's been seen as bullish because it slows down the creation of new coins.
But not this time, apparently.
Well, the performance after this halving has been the weakest on record, according to MarketWatch. Bitcoin gained about 43% in the year leading up to it, but the immediate reaction post-halving was pretty muted compared to the huge surges after previous ones in 2012, 2016, 2020.
Any theories why?
MarketWatch mentioned a couple of things analysts are pointing to. One is just the general uncertainty trumps trade policies, the global economic outlook. The Economic Policy Uncertainty Index is much higher now than during previous halvings.
So macro headwinds weighing on it. Even Trump reportedly talking about a strategic Bitcoin reserve didn't lift it.
Didn't seem to, no. Another idea from Kaiko analysts is simply that Bitcoin is maturing as an asset, meaning as it gets more integrated into finance with institutional money, ETFs, its price swings might become less wild. The kind of almost reflexive jump after a halving might just be less likely now.
Makes sense. Where's the price sitting now?
Around $92,136 last check. Still down about 15–16% from its record high back in January.
So the halving narrative might be changing. It's not an automatic moonshot anymore.
Seems that way. Broader economics and market maturity are playing a bigger role now beyond just the supply shock.
Okay, let's check in on the airlines. MarketWatch reported on Southwest. Here's how Southwest is trying to stay one step ahead of weaker travel demand. Sounds like they're adjusting.
They are making some pretty big adjustments, yeah. They actually pulled their financial guidance for 2025 and 2026.
Wow, that signals a lot of uncertainty.
It does. They said it's just too hard to forecast booking trends right now with all the macroeconomic uncertainty and softening travel demand they're seeing.
So what are they doing about it?
They're planning to proactively cut capacity, meaning fewer flights or smaller planes in the second half of 2025, trying to match supply with lower demand and save costs.
How much are they cutting?
Well, they now expect 2025 capacity to be up only about 1% year over year. That's a low end of what they previously expected. They'll try to achieve some of that by flying their existing planes more, like with new red-eye flights.
And what about near-term revenue?
Their forecast for the second quarter revenue per seat mile, that key profitability metric, is flat to down as much as 4%.
Right.
That shows the pressure on pricing.
And this is all happening while Southwest is making those big changes to its model, right? Like getting rid of open seating.
Exactly. Introducing assigned seats, premium seats, basic economy, bag fees, all things they resisted for years. It's aimed at boosting revenue, but it hasn't exactly thrilled all their loyal customers.
Tricky timing to potentially alienate customers when demand is already weakening.
It's a very delicate balance for them right now.
Okay, shifting to international finance. Raiffeisen Bank in Russia, Bloomberg reported. Russia rejects Raiffeisen appeal against $2 billion court order. That sounds serious.
It is serious. Raiffeisenbank International lost its appeal. A Russian court ordered them to pay over 2 billion euros in damages.
To whom?
To a company called Rasperia Trading Ltd. It used to be owned by Oleg Deripaska, the sanctioned Russian billionaire.
What were the damages for?
It relates to a really complicated deal that fell apart. It was an attempt to sort of repatriate some Russian assets using Rasperia's shares in an Austrian construction company, Strabag. But Western regulators blocked the deal.
And Raiffeisen had set money aside for this.
They made a provision back in January, yeah, but didn't say how much. This ruling confirms a very large liability.
Does this make it harder for them to get out of Russia?
Oh, absolutely.
Yeah.
They've been trying to exit Russia for ages, unsuccessfully. It's incredibly complex. This huge legal judgment just adds another massive complication.
Right. Okay, let's look at energy policy. Bloomberg had a piece, U.S. clashes with allies on energy security vision at IEA summit. Sounds like disagreement.
Clear disagreement, yeah. The International Energy Agency summit in London really highlighted different views.
What's the clash about?
Well, you had the IEA itself and the UK government hosting, really emphasizing renewable fuels for a sustainable energy future.
And the U.S. view.
Represented by Acting Assistant Secretary of Energy Tommy Joyce, was quite different. He apparently criticized the embrace of climate politics, suggesting it causes energy scarcity.
And promoted fossil fuels.
He touted America's role as a major coal producer and basically reiterated the Trump administration's opposition to restricting energy sources to hit net zero targets. They've criticized IEA forecasts before on this basis.
So a pretty clear split between the U.S. administration's approach and that of many allies focused on a faster green transition.
A very clear division and outlook on energy security and climate policy, yes, highlights the geopolitical angles too.
Okay, finally, let's touch on Tesla. MarketWatch asks, Tesla's stock is rising, but will Musk's return revive it for good? It's not so simple. So the stock bounced despite bad earnings.
It did see a bit of a bounce, yeah, even after what MarketWatch called a disaster quarter.
Why the bounce then?
Well, some analysts, like Dan Ives at Wedbush, are feeling more positive. He sees Elon Musk recommitting as CEO, maybe focusing less on, DOGE, coin, and political stuff, as a potential turning point.
He raised his price target.
He did, to $350.
Yeah.
Cantor Fitzgerald's Andrew Shepard was also bullish, also encouraged by Musk seemingly dialing back the distractions.
But Shepard had some caveats, right?
He did. He noted potential consumer backlash from Musk's politics, especially overseas in China and Europe, and also the impact of Trump's tariffs, potentially making Chinese buyers prefer non-American EVs. He actually lowered his target slightly to $355.
So even the bulls see some hurdles. What about more cautious views?
Oh, yeah. Needham's Chris Pierce is still cautious. He sees stress in the core auto business, no clear demand rebound yet, and thinks they might need more promotions. He's sticking with a hold.
And Oppenheimer.
Colin Rush there is also on the sidelines, perform rating. He pointed to Tesla's history of delays on big promises, like the robotaxi.
So the takeaway is, it's complicated.
Pretty much. Musk's renewed focus is seen as a positive by some, but Tesla still faces huge challenges. Tariffs, competition, delivering on promises. A sustained stock revival isn't a slam dunk. It's not so simple, as the headline says.
It really shows how much hinges not just on the cars, but on execution, competition, and Musk himself.
Absolutely. A complex mix of factors driving that stock.
Okay, so quite a tour today. We saw gold's big drop, raising questions, while silver emerges as a maybe. Stock market volatility definitely fueled by tariff worries and mixed signals from banks. Alphabet facing big AI spending and legal hurdles.
Right. Bitcoin's halving didn't provide the usual fireworks. Southwest is cutting back due to weaker demand. Raiffeisen hit with that huge Russian court order.
Plus, the U.S. diverging from allies on energy strategy, and Tesla. Well, Tesla being Tesla, a mixed picture despite a stock bounce.
Hopefully this deep dive gave everyone a clearer picture of these major stories and what's driving them.
Yeah, aiming to get beyond just the headlines. Lots to think about there.
Indeed. Plenty to keep an eye on in the coming days and weeks.
We'll see you all tomorrow morning with new headlines from major financial magazines.